Hello, and welcome to today's Rystad Energy Upstream webinar that will share our latest observations from the Upstream Analytics product. My name is Matthew Allen, and I am a representative of Sales and Marketing at Rystad Energy, and will be the moderator for this webinar. Our webinars run as a part of our frequent industry insights around upstream, oilfield services, North America shale, market and renewable solutions. We offer various industry newsletters, as well as information sessions, webinars, and similar types of events, which we invite you to sign up to if you haven't already done so. So keep an eye on your inbox or visit our webpage for upcoming events and for newsletter sign-in. Today, I have Veronika Akvinitsova, a senior analyst at Rystad Energy. She will share with you the latest trends in the upstream industry and introduce you to our Upstream Analytics product. We will now commence with the presentation. On your webinar window, you are able to see a chat box where you're welcome to raise any questions you may have during or after the course of this webinar. We will respond to each of the questions following the webinar. The presentation will last approximately 30 minutes. And with that, I now hand you over to Veronika.
Thank you, Matthew, and thanks everyone for joining our Upstream Analytics webinar. Powered by our suite of upstream products, today we will go through the recent updates for exploration and production activities globally. The agenda for today includes Rystad Energy's latest outlook on liquids production, supply-demand analysis, and price development, followed by most recent insights from OPEC shale and global field development. In the second part of the presentation, we will cover investments forecast and company guiding, major cost trends, recent global transactions, and discovery updates. But before we move to the content side of this presentation, I would like to take you through the overview of our upstream solution products. From early this year, we updated our Upstream Analytics portfolio to include a set of additional products and features. Now, apart from our upstream database, UCube, all clients get access to hundreds of asset reports and country fact sheets with a detailed overview of recent activity and forecast. With each release of UCube, we also publish a monthly upstream trends report with key insights into E&P industry. Every week, we aim to publish commentaries covering key industry events and hot topics. And our UCube Premium subscribers also get access to economic model, an Excel tool where you can change any modeling assumption and observe immediate impact on production, cash flows, and valuation. Finally, our analysts are always available to provide extra information on our methodology and assumptions. In today's presentation, we will be answering key industry questions through the use of insights from our upstream trends reports, as well as highlights delivered by commentaries and fact sheets. Let's start off by looking at global liquid supply growth to 2022. You see yearly liquids additions split by contributions from all supply segments with OPEC given separately. We see positive liquids additions of 2.5 million barrels per day in both 2014 and 2015, driving market oversupply. In 2016, liquids output has grown by 100,000 barrels per day only, and we see continuous growth in volume since then. This year, even with OPEC cutting down supply, liquids growth is set to reach more than 1.5 million barrels per day, powered by shale segment. Towards 2020, if OPEC doesn't continue to cut production, we observe yearly additions growing to the level of 2014-2015. Apart from shale volumes, we expect return of OPEC and contributions from deepwater projects that were sanctioned before the price collapse. Only after 2020, the impact from lack of sanctioning in the last couple of years becomes visible, with little additions from offshore, OPEC, and other onshore segments. Yet shale is strongly continuing its growth of at least 1 million barrels per day. If we plot total supply against our total demand expectations going forward, we see that while supply is forecasted to be below demand in 2017-2018, which contributed to the price increase so far, in the medium term, positive stock build is expected. Next year, supply is around 800,000 barrels per day higher than demand, and stock change becomes even larger during 2020-2021, reaching 1.8 and 1.5 million barrels per day, respectively. Therefore, there is a need for OPEC to continue to balance the market next year. Nevertheless, in the medium term, we see continued downside risk to current oil prices. Only by 2022, we anticipate market to come close to balancing again. If we look at the sources of long-term supply comparing it to the output in 2017, we see that around 22.2 million barrels per day will come from not yet producing fields. In 2017, total liquids production stood at 96.7 million barrels per day. And towards 2022, mature field decline is estimated to remove 19.8 million barrels per day from the total output. The ramp-ups from early producing fields counter 5.2 million barrels per day of this, resulting in an overall drop of 14.6 million barrels per day from currently producing fields. At the same time, onshore discoveries will add almost 13 million barrels per day. 3 million barrels per day will come from new shale wells and 6.1 million barrels per day from sanctioned and unsanctioned offshore projects. Overall supply is thus forecasted to potentially reach 104.3 million barrels per day by 2022. This represents a small stock build of 200,000 barrels per day, as our current demand expectation for 2022 is 104.1 million barrels per day. The supply-demand dynamics we see taking place in the medium term led us to oil price forecast revisions that were implemented last month. Orange line depicts our most recent Brent price forecast until 2022, while dashed line shows previous estimates. This year, we estimate an average price of 71 USD per barrel, driven by tidal market balances, strong demand, and OPEC compliance. In 2019-2020, supported by the risks of renewed oversupply, we expect prices to go down and reach 66 USD per barrel in 2020. From 2021, our bottom-up data indicates strong effects from the long oil cycle, as additions from new fields are not able to balance declines from maturing fields. At the same time, US shale growth will gradually taper off, and we see limited capacity within OPEC to add overall crude production after 2020. Therefore, a gradual increase in oil prices is forecasted from 2022 onwards. We can now move on to the regional insights and look at some of the key trends in OPEC and shale production that are shaping oil markets in the medium term. Top chart shows global view with total OPEC production split separately by contribution from Persian Gulf countries, Libya and Nigeria that have been growing this year, and remaining OPEC countries that are declining despite the production cut targets set for them. We also added Russia into the picture, as countries' agreement with OPEC is vital for market balances. Total oil and liquid supply are also depicted on the chart. Long-term growth is very much driven by shale, which adds almost 9 million barrels per day by 2025, while total OPEC contribution is just around 2.6 million barrels per day. As a result, global liquids production is set to reach almost 111 million barrels per day in 2025. Looking at more short-term quarterly dynamics, as depicted by year-on-year oil additions, we see that Persian Gulf countries are not adding volumes during 2018, with just some seasonal increases expected in the second half of the year. Recovering from supply outages, Nigeria and Libya increased production in the first half, but still produced below the targets set for them. Shale delivers strong production growth as expected throughout the period, and remaining OPEC countries are producing below the target set, driven by mature field decline. In total, in 2018, OPEC is expected to produce at 32.67 million barrels per day compared to the new cut target of 33.42 million barrels per day. If OPEC agreement is not renewed next year, we see OPEC and Russian oil volumes again gradually flowing into the market. However, if OPEC agreement is extended, around 800,000 barrels per day of supply will be removed in the base case, contributing to the market balancing in 2019. In terms of OPEC future potential to add volumes, we see relatively little growth from the region, even if the agreement is not extended. Total supply in such cases forecasted to increase to 33.1 million barrels per day next year and grow to 33.9 million barrels per day by 2020. Due to aging fields and lack of investments in new production capacity, many OPEC member countries' production is in natural decline. The group of decliners driven by Venezuela, Angola, and others slide by 300,000 barrels per day in 2019 and by 900,000 barrels per day between 2018 and 2022. Without cut extension, OPEC production increase of 440,000 barrels per day is estimated to come from Persian Gulf countries as UAE, Iraq, Kuwait, and Qatar that are able to ramp up production will do so. We expect Saudi Arabia to maintain flat output in line with its policy to seek a stable oil market. And OPEC members, Libya and Nigeria, are among the most uncertain due to political instability. Our current forecast shows a 50,000 barrels per day decline in Nigeria as it struggles with aging fields, compensated by the same growth in Libya between 2018 and 2022. Furthermore, through the use of UKIP integrated country fact sheets, one can quickly access latest data for any country in the database. Right now, I have a couple of examples from our country report for Iraq. The summary page straight away shows key takeaways. We observed that oil production is expected to reach 4.7 million barrels per day in 2018, primarily represented by oil. Production profile on the right illustrates expected ramp up in output towards 2030. So far, Iraq is expected to grow production the most among all OPEC countries, reaching above 6 million BOE per day after 2025. Around half of remaining country resources are represented by not yet producing fields, which is visible on resources chart as well as on the country map that depicts location of Iraq fields by life cycle. Production growth in the medium term is driven by sanctioned not yet producing fields, which will increase oil production by 385,000 BOE per day by 2022. The third snapshot shows investment and production profiles for the key sanctioned fields expected to start up in the medium term. The table also highlights break-even prices and field-specific data for each one of the top 10 fields selected. The largest field to start up next year is Phase 1 of Kwarna West, with resources of nearly 3.3 billion BOE. Halifah Phase 3 and redevelopment of Majnoon field are also expected to begin commercial development during 2018-2019, bringing an additional 4 billion BOE on stream. Let's now turn to recent trends and insights on shale side. From the top chart, we observe that completion activity has caught up with rig counts in late 2017, but was exposed to some interruptions amid winter storms in December 2017 and January 2018. However, once the winter outages were resolved, completion activity jumped in February and reached a new high level. So for the remainder of the year, we expect flat development in rig counts, but completions are estimated to grow by additional 7% by the end of the year as more frac spreads are deployed. We currently estimate activity to stay on the trend of gradual growth through 2019. On supply side, as of February 2018, shale oil production from horizontal wells increased by 1.45 million barrels per day year on year. And current activity level is sufficient to achieve additional growth of 0.9 million barrels per day by December 18. Thus, oil production is anticipated to average 6.25 million barrels per day in 2018, showing a growth of 1.4 million barrels per day compared to 2017. Moreover, current drilling activity is sufficient to deliver a stable production growth above 1 million barrels per day in 2019 as well. Thus, oil output from shale is anticipated to reach around 7.4 million barrels per day in 2019. Our forecast for 2018 is aligned with what shale companies are guiding in terms of production growth for 2018. In one of our earlier shale commentaries delivered to the clients, we looked at 2018 guiding provided by some of the key US onshore companies. We found that the majority of large producers expect a double-digit increase in both oil and gas volumes produced this year. On average, companies are guiding around 19% increase in liquids and about 10% increase in gas. Decrease in volumes for some producers such as Cap Resources or Chesapeake comes because of divestiture programs planned. And at the same time, some companies like RSP Permian are leading in terms of percentage growth for oil and gas volumes, with more than 30% increase guided. In the medium term, we forecast light oil production to reach 9.8 million barrels per day by 2020. Largest additions in the following years are coming from Permian Basin, followed by Eagle Ford and Bakken. Yearly growth in shale oil production stands at around 1.4 million barrels per day on average in the next 3 years. However, if prices fall down to $50 USD per barrel, we are unlikely to see much expansion of shale production going forward. The output is then anticipated to grow to 8.3 million barrels per day by 2020, but still reach around 7 million barrels per day this year. On gas side, output is set to reach 13.5 MMBO per day by 2020, with with Marcellus and Montney contributing about half of the increase going forward. Total US shale output can reach around 27.3 million barrels per day in 2020 compared to 21 MMBOE per day estimated for 2018. In the 50 USD per barrel price environment, it can only expand to around 25.4 MMBOE per day. Moving on, every month in our Upstream Trends report, we provide an overview of the most recent startups expected. The table lists top 15 oil fields that are estimated to start producing during May-June 2018. Last month, Petrobras' Buzios field was the largest field to begin production with around 441 million barrels of resources. Among the biggest fields to come online in the next 2 months is South Pars project, which includes phases 22 to 24 and 14 expected in June. Cumulatively, the fields have recoverable resources of around 1.8 billion barrels with production plateau over 200,000 barrels per day. Then also in May, we expect 2 more startups in Brazil, Lula Phase 67 and Tartaruga Verde. Both are set to add more than 130,000 barrels per day at plateau. And overall, 2018 startups in Brazil bring about 880,000 barrels per day of liquids production at peak to be reached after 2020. The largest gas-producing field that started to produce in April was also Petrobras' Buzios, with recoverable resources of 0.7 trillion cubic feet of gas. Similarly to oil fields, the largest gas project to start up in the next 2 months is Iranian South Pars, with total gas production of nearly 3,000 million cubic feet per day at its peak. The combined recoverable resources from all startups for this period is around 54 trillion cubic feet, and the top 15 startups account for 99% of total recoverable reserves. Apart from Iran, Australia also shows the greatest growth potential from first half 2018 gas startups. In such a way, INPEX each these fields with recoverable reserves of 10.9 trillion cubic feet is expected to contribute 160 million cubic feet per day of gas in 2018 already. Our integrated UCube asset fact sheets allow to quickly access and analyze latest data for any field globally. We are now looking at examples from the asset report on Brazilian Buzios field, which as mentioned was the largest startup for the month of April. The field consists of multiple assets representing a phase development. On the first snapshot, you see a full overview of the field development going forward, with contributions from all phases to begin production in the future. Apart from resources, we also include data on capex investments, payback time, and break-even prices. And cumulatively, production from all phases is forecasted to reach 600,000 BOE per day before 2025. Apart from standard slides and key summary data, detailed maps, and future profiles, we also include short narratives covering the latest status, overall development concept, and details regarding reservoir, recovery strategy, and oil and gas transportation methods used. We highly encourage all UCube clients to explore the option to download integrated reports, which makes UCube data even more transparent and easily accessible. In terms of sanctioning activity, we see some recovery taking place since all-time low volumes in 2016. The graph shows global liquids production in fields at peak by sanctioning year, split by countries. Last year, we saw almost 2.1 million barrels per day in liquids peak production sanctioned for development, with Iraq, Brazil, United States, Norway, and Canada making up around 60% of the production potential. In 2018, we expect more than 3 billion barrels per day to be sanctioned, with activity dominated by Brazil, Norway, and Saudi Arabia. This is comparable to the activity we saw back in 2014. 2019 is forecasted to have nearly 7 million barrels per day approved for development, which is significantly higher than any year since 2012. Brazil, Iraq, Iran, and others are planned to significantly contribute to this increase. However, the actual production contribution from the field sanctioned next year will only be visible after 2022. The bottom chart shows liquids production profiles by sanctioning year. We see that fields that were sanctioned in 2016, for example, contribute the least to production now and going forward, while high production contribution was coming from field sanctioning during 2012 and 2013. 2019 so far is expected to outperform all other years, with production from associated fields reaching 5 million barrels per day by 2025. In contrast to growing sanctioned volumes, Significant recovery in total capital and exploration expenditures is not expected until 2020. While total investments are estimated to show some growth from next year on, the levels are not likely to reach even 2015 numbers by 2020. 2018 is expected to be rather flat compared to last year, with growth of 18% coming only from shale and tidal sector, and mostly all others continuing to decline. In the medium term, shale tidal continues to realize double-digit growth of around 12% CAGR. Deep water segment is also forecasted to grow by almost 6%, followed by other onshore with 3.6%. Total capex is anticipated to reach the level of $590 billion by 2020, growing from $520 billion estimated for this year. Our forecast is in line with the communication we saw from company guiding last month. We analyzed 2018 guiding for the companies that provided levels of planned investments for this year, which covered around half of the E&P sector, and found that overall there is modest growth in E&P investments planned. Majors are guiding almost flat investment growth, while shale-focused companies are guiding at least 13% increase in capex. The bottom chart also shows guided increase by companies. Total, Chevron, Eni are among majors that plan to decrease investments this year, while Exxon, Conoco, and Shell still guide some increase. Among shale-focused companies, Oxy expects the largest increase in spending, taking into account company's EOR projects, followed by EOG with more than 40% increase. In addition, as published in our shale-focused commentary a while ago, we looked at shale portfolio guiding separately. So while on the previous slide we saw that some majors are guiding decrease in overall spending, investments vary a lot by segment. In such a way, Chevron, for example, which plans to decrease total spending by 9% in 2018, expects more than 40% increase in shale spending, similar to such key shale producers as EOG Resources and Oxy. Taking this into account, overall shale spending guiding for companies analyzed came close to 20%, just like is expected in our base case scenario. Looking at total forecasted shale investments going forward, we estimate just around 12% increase yearly from 2018 to 2020. This is considerably lower than 29% CAGR seen before 2014 and 68% increase realized last year. Oversupplied market and likely decrease in oil prices that we currently forecast lead to lower spending growth in the medium term. In line with the trend we saw last couple of years, majority of investments will be directed to Permian plays, followed by Eagle Ford and Bakken. Overall, Permian Delaware is now leading in terms of drilling and completion activity, now in the years to come. And total shale spending is forecasted to reach $17 billion compared with almost $19 billion spent in 2014. Another topic that has been attracting a lot of attention recently is cost trends and development in break-even prices across different supply segments. This month in our Upstream Trends report, we provide an update on key findings here. On the top chart, we'll look at the number of completed wells for different supply segments and see that in line with the spending increase, shale realizes the highest growth. By 2019, it reaches the same activity level as we saw back in 2014, completion of around 20,000 wells per year. At the same time, as we saw on the previous slide, total investments in 2020 are not reaching the levels of 2014. Therefore, by comparing investments to activity levels, we observe how unit prices have come down. For shale, the decrease is around 20%, as the same activity level as in 2014 can now be achieved with 20% lower capex. We also track the changes in our estimated break-even prices at the start of each year for the different supply segments. And overall, we see that since 2015, break-even prices have come down the most in shale segment by 42%, followed by other onshore and offshore midwater with 35%. Deepwater reduction stands at 27%. And as of today, average shale break-even is the highest with around $55 per barrel, followed by offshore deepwater at $50 per barrel, and other onshore still being the cheapest at $38 per barrel. Even though shale remains to be the most expensive source of production, the gap has now narrowed considerably since 2014. Now the cost between supply segments doesn't vary as much as before. Coupled with high variability of break-even prices dependent on the shale play and the area, shale fields can now be cheaper to develop than some of the offshore projects. Finally, it's not just the development costs that have fallen within the E&P industry. Also, the operational costs have been coming down significantly. We analyzed change in operational cost per BOE in 2017 compared with 2014 by country. For offshore, the average cost per BOE has dropped around 25% from 2014 to 2017. For onshore, the reduction has been around 20%. United Kingdom, Norway, and Brazil are among the countries that realized the largest cost savings. On the M&A side, last month, total dollar value of global deals stood at $18.3 billion, representing a decline of 12% month-on-month. And still, April has so far this year been the second most active month in terms of transaction value. This time, however, North American deals represent a small share from the total deal value with barely 17%. Australia, on the other hand, accounted for the largest part of the total. Among notable transactions, in early April, Harbour Energy made an offer to acquire the third largest energy producer, Santos, for $13.1 billion. In Canada, Vermilion Energy agreed to acquire Spartan Energy Corp for around $1.1 billion. And in the US, Lower 48, Comstock Resources acquired Bakken assets through a reverse merger with Arkoma Drilling and Williston Drilling for $620 million. Also, Chevron's divestment of its working interest in the Elk Hills field accounted for over $500 million. Compared to first quarter 2018, April has also been a weaker month in terms of discovered volumes. In 2018 so far, we have seen a ramp up in discovered resources with monthly levels standing above 1 billion BOE per month. This represents an upward trend from the extremely low levels we saw during the last 2 years. Barely 8 billion BOE was discovered during 2016-2017. Among the largest discoveries so far this year are Calypso in Cyprus and Baltimore in the US, both with discovered resources of more than 500 MMBOE, followed by Pacora and Ranger in Guyana. Last month, we also added Hader Iris field in Norway, operated by OMV, and Avila fields in Gabon, operated by Rystad. Both are estimated to hold more than 100 MMBOE of recoverable reserves. On this note, I'm finishing today's E&P webinar. Thank you all for your attention.
Thank you for listening in, and thank you, Veronica, for giving this fantastic introduction to the Upstream Analytics. With this, we conclude today's webinar. If you would like a more in-depth product demonstration, please don't hesitate to contact us, and one of our sales team will be in touch. Once again, thank you for attending.